We've got Andrew Freris, who's Senior Investment Advisor at BNP Paribas Wealth Management, who joins us on the show from Hong Kong. Andrew, to begin with, the FY13 fiscal deficit has been targeted at 5.1% by the Finance Minister. Now, some people believe that there is an upside risk to this estimate, that we may not achieve this. What's your view?
Frankly, I tend to ignore what other people are saying, and I prefer to stick to what the bank is saying. We're looking at a potential deceleration in GDP growth for the next fiscal year, and once this happens, it is always very difficult, in fact, to cut expenses, given that the tax base is likely to shrink. Remember, we are talking about relative terms. And also, the Indian fiscal system has a long tradition of overshooting rather than undershooting its targets. And we still have zero resolution on the issue of subsidies, which are a very significant part of the overall expenditures of government.
Right, Andrew, the Finance Minister is also assuming some of those assumptions based on a GDP forecast of 7.6% for the next financial year. Would you say it's a reasonable estimate?
The economy grew at 6.9% this year, and there are still no signs of a significant recovery, particularly, of course, as the Reserve Bank of India is unwilling at this stage to start cutting interest rates. And given that the fiscal impetus that was given in the budget measures is very meager, to put it mildly, I really don't see where the growth is going to come out, given that India, of course, is overwhelmingly a domestically driven economy. We have to remember that, for example, in the last 3 years, if I was to take the last 12 quarters of GDP growth, in half of those, net exports made a negative contribution. So this nonsense that India is perhaps slowing down because its exports are not performing, this has always been the case. In other words, this is not an issue that it is a new issue. The external sector makes a small to a negative contribution in India's GDP growth, and what really matters is domestic. In other words, investment and consumption. And of course, investment to a great extent has been dampened down by the increases in interest rates, and the budget didn't really offer anything in terms of growth. But then I think it's an unfair criticism of the budget, because it's a coalition budget. It is meant to be neutral, in other words, fairly tasteless and fairly odorless. And I think that has to be said to its defense.
Afternoon, Andrew. Ivan joining into the discussion. What is your opinion as to how you think India's government tackled the fuel, food and fertilizer subsidies so far, and how do you believe it's going to change going forward?
It didn't, and it will not. It's very simple. It didn't tackle it, okay, because it can't, because it's a coalition government, and we have seen what happens each time something which is, let's say, socially sensitive, it's touched, and therefore I just can't see what it's going to do in the next 2 years coming up to elections. So my answer is terribly simple. It hasn't, and it will not.
And India has also widened its tax base. The service tax net has now been widened. Do you think that this is a positive move, and how big a positive would you think it is?
It is okay, but if one looks at the specific details, they are full of micromanaging details. In other words, I really believe in flat taxes right across the board, and you have merits, demerits, lower merits taxes. The service has been increased, but there are 17 negative issues that have not been touched. In other words, I would like, this is none of my business to tell the Indian government how to run their tax systems, but flat taxes are taxes that make a lot of sense, because the more exemptions you have, the less clear it is how this is going to affect the overall amount that is going to be raised. After all, you are imposing taxes. You know, taxes should be there to raise revenue, not to micromanage the economy.
Right, Andrew, now the government's also amended income tax laws with retrospective effect, giving powers to the taxman to essentially chase transactions similar to the Vodafone transaction we saw, essentially all cross-border deals struck in the past. How do you believe the foreign investor community is going to react to this? And would this move give the Indian government scope for getting more tax receipts?
Well, I prefer to concentrate one moment on aspects of the income tax reforms that included some really arcane sections whereby all the people that don't have business income may or may not give us some allowances. In other words, I really fail to understand, given that nearly 60 to 70% of the population of India works in land, and I'm sure these poor farmers don't pay one penny of income tax, what this is being addressed to. As far as retroactive taxes, in fact, any retroactive act of parliament and any retroactive action is bad. It's full stop. You can actually say, up to this particular point we were given exemptions, going forward we will not. That's perfectly okay. In other words, the playing field has been prepared level, so you know what's going to happen from next year. But things that were legal last year being made in inverted commas illegal, it is just not on.
Now, Andrew, also the disinvestment target for the financial year FY13 has been scaled down something like 25% lower than the previous financial year. How are you viewing this move?
In fact, I think they are almost irrelevant, because each time there was a real attempt to privatize, it has been stopped dead in its tracks. I would really, if one is going to say that they are going to raise money by selling government assets, okay, it's best to see actually a series of proposals. And again, I'm not holding my breath, because this is a coalition government. I think it's terribly unfair to criticize the Indian government on what it can or it cannot do and tell them that this is what they should be doing. This is what they can do. You know, politics is the art of the possible, not the art of the desirable.
Andrew, many have deemed this budget as a non-event, but how big an impact do you think this budget has on the Indian equity market? And will the kind of fund flows that we've seen in India to date, which is close to $8.1 billion, remain healthy for the rest of the year as well?
Well, the market had, of course, a knee-jerk reaction. Negative, which made a lot of sense because there was nothing in the budget that will attract its attention. And going forward, in fact, I think the budget now, it's an irrelevancy, all right? It is tasteless and odorless. People call it a lost opportunity. I call it simply an opportunity well expected. So going forward, the Indian market remains one of the most expensive in Asia, both in terms of forward, 12-month price earnings and price to book. And until and when the Reserve Bank of India begins to cut begins to cut interest rates, this is going to be a cloud which will be hanging over it.